Estamos en un momento en el que además el que va a ser previsiblemente el próximo canciller germano, Friedrich Merz, ya ha hablado de incrementar, de disparar el gasto en defensa y además de aligerar, por así decirlo, las reglas fiscales. ¿Cómo pueden tomárselo los mercados? Vamos a preguntárselo a nuestro siguiente invitado. Arnaud Mounier, jefe de desarrollo de negocios de renta fija en Alliance Bernstein. Hello.
Hello, good afternoon.
Thank you very much for being with us today. We have been talking about the German economy and how did markets react to the proposal by the incoming German Chancellor Friedrich Merz to increase fiscal spending of infrastructure and defense?
Well, to say the least, it was very spectacular. To put things in perspective, the one-day change in yield in Germany was the largest move we have seen since the Berlin Wall fall. So the interest rates move more than 40 basis points higher in Germany, about 30 to 35 basis points higher in France, in Italy, and in Spain. The response was more muted in the UK, was more muted in the US, but overall a very spectacular move, which was not necessarily translating the fact that the market was very concerned, but was more the reflection of an adjustment of the level of interest rate that would be normal given the expected, I would say, spending in Germany.
And Arnaud, given all the uncertainties in the world, geopolitics, trade wars, concern of growth, the equity markets are reacting quite negatively. What about credit markets?
Well, there is a bit of a paradox here. I would say when people think about the correction in the equity market, it's been quite severe so far. On the credit side, if you look at good credit quality names, investment grade quality names, you have not seen any change or almost no change in credit spreads. So the level of demand, the good quality of these assets have made them fairly immune to the price correction we have seen on the equity side. If you look a bit lower in terms of credit quality, European high yield spreads have widened a little bit, but very, very muted reaction compared to the equity market. So overall, we have not seen a sell-off across the board. I would say it's more a reflection that US equities in particular, given some of the concern, as you mentioned, on geopolitics, on trade wars, on tariffs, are forcing investors to make a repricing of this asset class, which was already considered as quite expensive, but people were attracted to US equities because of prospect of better growth in the US. Now that the growth is a bit more of a question mark in the US, there is this repricing happening. But in the credit market overall, we have not seen any panic at all. And I would say investors in the fixed income market have been waiting for better entry point. And so there is a lot of cash waiting to be invested. So really not any panic in the fixed income credit market.
Do you think are investors getting more nervous about investing in the US as far as fixed income is concerned?
Not really. Look, I think obviously people are asking more questions about the US outlook. I think as Mr. Trump mentioned, the risk of recession has increased. And so obviously it gets people a bit more concerned with growth prospect in the US. But people were also a bit concerned with the prospect in Europe, obviously. And the US market remains a very attractive market for a number of investors in Asia, for instance, a very safe haven. We will still see demands for US Treasury, for safe assets from the US. So overall, we are not that concerned with investors avoiding the US market. That being said, we are seeing a lot of volatility in interest rate movement. So people are a bit, I would say, prudent before buying long-term duration product. We are not seeing a lot of demand for long-term product, long maturities, and people are more focusing on more intermediate duration product.
And I don't know, what do you recommend from Alliance Bernstein to your clients in terms of fixed income allocation in this context?
Yeah, look, I think we have to remain quite nimble. I would say if we look at the more medium to longer term aspect, you see the ECB's cutting rates, whether they are going to be at 1.75% or 2% by the end of 2025 is still a bit of a debate, but they're going to be lower and lower remuneration on your cash deposit, on your bank accounts. And so the case for going longer in terms of maturity, looking longer term yield in Europe makes a lot of sense now that yields are higher in Germany, in continental Europe overall. You have a better entry point for investors. We know they are still concerned about the outlook, the short-term volatility. So some clients might be a bit concerned with that. But as long as you take more of a 3 to 5 year horizon, you should be very happy with the kind of yields you are getting. If you look at the yields, again, on a German bond obligation, on a bonus in Spain, and you adjust that for the inflation that has dropped a lot in Europe, then the real yield that you are capturing as an investor is quite attractive at the moment. So I would say the main advice is try to move a bit beyond the short-term noise, which is going to be there for to remain, and look at the kind of yield you can lock for the more longer term for the next 3 or 4 years.
Arnaud Mounier, jefe de desarrollo de negocios, renta fija, Alliance Bernstein. Thank you very much for being with us today.
Thank you.